So normally to buy 100 shares of SPY, it would be 561 times 100, which would be roughly $56,000. However, if you just want to have the contract for 100 shares for a day, it's only going to cost you $147. Stock option trading can be a little complicated at first, so today I'm going to be explaining it to you from a beginner's standpoint. That way you can more easily understand. So the basics of options trading is that you get to create a contract saying you have the rights to 100 shares of a stock at a certain strike price that you get to choose. And the only downside is your contract has an expiration date, which you also get to choose. Let's take a look over at Robinhood. Here's a little portfolio update for me. Doing great for the week. The real big ones for me right now are SoFi and this one, NGD, New Gold. Those ones are performing excellent for me. I would highly recommend those. But we'll take a look at those further in depth in another video. Today we're just going to head on over to SPY. So the S&P 500, the total market. And I'm using Robinhood. And if you don't have a brokerage account, I'd highly recommend Robinhood. It's very easy to understand and navigate through there. I also have a referral code, which will be the first link down in the description, where you can get some free shares. It's totally free. You don't have to pay anything like that. You just got to link your bank account to Robinhood, and after that is done, you'll get some free fractional shares of a stock that you get to choose. And it kind of just gives you a little beginner's eye as to how the market works. How do you buy shares of a stock? How do you sell it? And how the stock market will fluctuate over time. But anyways, so you head on over here to options trading. Oops, I think my camera was covering it. Boom. Right over here. Trade options on SPY. And the biggest things you're going to want to look at is these top ones right over here. You have the buy, you have the sell, and then the call, the put, and your expiration date. So as I mentioned before, the expiration date is for how long your contract stays open. So let's just start off from the beginning so you can get an understanding of how it works. So I am on the buy and the call tab. So a call, when you do a call option, that means you are bullish or you think the market is going to go up. On the flip side though, a put, you buy a put if you think the market is going to go down or bearish. So to give you guys a good example, let's just say I wanted to buy a call going out to, let's see, tomorrow is Monday. So let's just say it expires Monday. I'm opening it Monday and expires Monday. And I'm going to choose the 562 strike right here. So here's a nice little graph to demonstrate what this contract will do for you. As you can see, if the right in the middle, that is the current price of SPY. But as that, if the strike price goes down a little bit, you're going to lose some money. But notice as you go up more, when you're buying a call, you're going to have a lot more expected profit. So you may be asking yourself, okay, so if I'm buying a contract or creating a contract saying I have the rights to 100 shares, why wouldn't I just go and own 100 shares? And the reason for that is leverage. And leverage is your biggest friend when you're doing option trading. So take a look right here. The rights to 100 shares at the $562 mark right here, it's only going to cost you $147. So this right here is called the ask price or the premium. So for one share, it's $1.47. But, it's a contract for 100 shares, so you just move that decimal place over twice, and that's how they get that max loss number or how much it costs for you to purchase this call. And as you take a look right there, so it costs $147 to buy a contract saying you have 100 shares. But you could still make a great amount of money. However, going back to the normal price of SPY up here, which is $561 for one share. So you times that by 100, and that is $56,000 for 100 shares. Now, the nice thing about owning just straight up shares versus doing the contracts is you're not on a time expiration. Your shares are going to stay until you sell them. However, the options trading is limited to the expiration that you get to set. So whenever you buy a call, you're saying the market's going to go up. And whenever you buy a put, you say the market's going to go down. So some people, the basics of their trading strategy is just, okay, so the past week the market's been going up. Past month still looks up to me, so I just think it's going to keep going up. Then you just find a price that you're comfortable owning 100 shares at. Click it, you buy a call. Oops, I think I did the put. And then you set your expiration. So how long do you want your contract to stay open? Now, one thing to note, so this one opens up Monday. It costs $147. But let's say I want to go out to that Friday. So September 20th, that is the Friday. Now for that that same strike price, it's going to be $411. So $4.11 per share, and you have 100 shares. So it's going to be $411. So the caveat of having a longer expiration is that it's going to cost you a little bit more. However, it is going to be a lot safer to have a longer expiration. One thing to take note of is the Greeks. So once you can actually click on each of these strike prices to get a little bit more information about them. When you open up your strike price, you're going to be presented with a lot of different numbers and information. The ones that I mainly focus in on is the theta and the delta. The delta is pretty much just the percent chance that you're going to make money on this option, and the theta is the amount your contract changes in value with each passing day that the contract is open. So right here it is a negative 0.42. So that means each day that this contract is open, remember we got to times it by 100, you are going to lose $42. So that is for the 5 days. So each day you're going to lose you're going to lose the $42. And if you add that up, that should equal about to your max loss. Now, when we change that expiration, going back to this Monday versus the Friday, expand that one, and you can see right there the theta decay is a lot higher. So now, because there's only 1 day, well, I guess it counts this Friday as because it's the weekend, it's going to be a little different. But because this contract only has 1 day that it's open before it expires, it's going to have a lot higher theta because just the contract will lose value each day that it's open. And if it's only open for 1 day, then that's its whole value right there. So your theta will change depending on your expiration date. The longer you go out, the less theta decay and the safer your option is. The only downside is it's going to cost you a little bit more. All right, so you think the market's going to go up, you buy a call. And on the flip side, you think it's going to go down, you buy a put. Once you're comfortable, you choose which strike price you like. Let's say you check out the price history. Past month, it hasn't gone above 562. If you wanted to, you could go up to 562. Maybe you think that's a little reject spot. It's rejecting off this every time it hits this number, it goes down. So you could just say, okay, for the rest of the month, for 1 month going out, I don't think the market's going to go above that 562. All you got to do, set your expiration, make sure you're on the buy, make sure you're on the put, find that strike price right there, and boom, there's a nice little graph. Now, this one, it obviously, as you can see, it's going to cost you a little bit more, but it is going to be a lot more safe. So going out 1 month, let's see, theta decay, now you're only losing $12 per day that it's open versus 73 or the 42. When you are buying options, it is a lot more simple. It's easy to understand. All you got to say is, hey, I think the market's going to go up, or hey, I think the market's going to go down. Simple and easy. But when you flip it and you change from buying to selling, things get a little bit more interesting. Whenever you are selling options, you're either going to need to have the capital to buy 100 shares, or you need to already own 100 shares of a stock. Let's take a look at a smaller one, SoFi. SoFi is a nice little technology stock. A lot of people are saying to hold it and buy it. It kind of bounces. If you look at the last 3 months or last year to date even, it just bounces between 2 price points. So it's really great for the wheel strategy, which utilizes those sold options. So whenever you're buying an option, someone sold that to you, and now you have the opportunity to sell that option to someone else. As you can see, I'm up about 10% on this stock. Um, I just bought 100 shares at the $7 price because I sold a put at the $7 price and I was forced to buy it. So let me explain that better. Open up your options, and now we're going to click on the sell. And to start off with selling options, I'm going to talk about selling a put. So usually when you sell a put, you think that the stock is going to stay above a certain price point. So let's go out to not next Friday, but the following Friday. So this is about almost 2 weeks. So let's say you wanted to do the 750 strike price. So remember how the last time you would have to pay whatever this premium is, but when you're selling options, you are the one collecting that premium. So someone else is paying for it, and you're the one who's collecting it. So now each of these premiums over here is the money that you're going to collect. So max profit right over here, and then the max loss is right over there, and all that max loss is just you being forced to buy the 100 shares if the share price dips below that price you choose. So when you sell a put, you think it's going to stay above your certain price. I think it's going to stay above the 750, so I'm going to click this contract, and if for every day that it stays above the 750, I'm going to collect a part of that premium, or that $18. And remember how I talked about theta decay? Well, the same thing applies to selling options, except notice how there isn't a negative right there. And that is because this is the amount you're going to gain each day as long as the share price stays above the strike price you chose when you sold your put. I know that sounds a little complicated, but I'll show you some more examples here in a second. But now for this one, for the theta, you're going to gain $1.10 for every day the contract's open. So you do gain a lot less when you sell options. However, it's a lot more consistent and it's a lot more safe, because whenever you're buying options, time is against you. You have to the stock has to move to a certain price more quickly, or else your contract is going to lose value. But on this side, you sold the contract to someone else, and you hope that they lose money, their contract loses value, and they're going to pay out that loss to you. So for every day that SoFi, right now it's at the 775 mark, so every day it stays above this 750 strike price, I'm going to collect this $1.10 throughout the course of these 12 days. However, if the share price for SoFi drops below this 750, and let's say maybe gets to $7 or the 650 mark, and my contract expires, meaning it's over, the date is passed, then I will be forced to buy 100 shares of this stock at the strike that I chose, which would be 750. So even if the stock goes down to $6, I still have to buy at 750, and that would be a $150 loss. So a lot of people get into trouble when they sell options because they'll do something like this. They'll be attracted to the premium, it looks good, but then the strike price will end up dipping down and their contract will execute, meaning they have to buy the 100 shares at a higher price than actually the current price of the stock. So it can be a little tricky, but there's an option trading strategy called the wheel strategy. And the basics of that is you start off by selling a put, and then you're going to collect that premium, and then if the share price dips below and your contract gets executed and you'll be forced to buy the 100 shares, then what you do next is you're going to go over here and you're going to sell a call. And when you sell a call, you're doing a similar thing where you say, I think the stock is going to stay below this mark that I'm going to choose. So still on SoFi, still about 2 weeks out. I think it's going to stay below $8 for the rest of this week. So then I would click the $8 strike price, and boom, as you can see this graph, very helpful. Right there, and every day it stays below here, I will gain that premium. Check out the theta, move it over. So this one I get $1.20 each day that it stays above. But the cool thing about selling a call, so when you sold a put, if it dipped below and your contract got executed, you'd be forced to buy 100 shares. But when you sell a call, let's say that this share price goes above this mark, then I will be forced to sell my 100 shares at the strike price I chose. So even if it goes up to $9, I still have to sell it at $8 because of the strike that I chose. And one important thing to note is, as you can see right here, the max loss is unlimited. And that means you can't just buy a naked, or you can't just sell a naked call. You have to have 100 shares of the stock in order to sell a call. However, there is a way around this. There is a really cool strategy called a leap. And what a leap is you just buy a call. So I think the market's going to go up. But instead of having it expire in 1 week, 2 weeks, 3 weeks, you actually go out a year or two even at times. And that's if you're really bullish on the stock, you think maybe it's going to have some ups and downs throughout these few months. But overall, I really believe in this stock. I think it's going to do well. Again, it's going to cost a little bit more than it would for a lower expiration. But it's a lot more safer, So let's check out this theta decay. So this one right here, move it over. You're losing 20 cents each day versus even $1 or $2. So a lot more safe. And the cool thing is, so remember when I said when you're buying a contract, you're creating contracts and you have the rights to 100 shares, you are actually able to have this out here as a leap. So you'd buy the call at the $7 mark. If it goes up, you make money. But technically now you have 100 shares. So if I wanted to, I could go switch it over. I could sell the call. And let's say I want to sell this call every 3 weeks. And I could do this one right here. So I could execute this contract, and I would gain this $24 in premium as long as that this call is still open, that leap, that year-long call is still open. And then, so it's kind of like a synthetic way to own 100 shares. So instead of spending $775 to buy 100 shares, I'm only spending about $260. So it's a little cheaper. It's kind of a nice thing to do if you just don't want to own 100 shares. And then you can do it each week or each month. If you want to gain this premium, you could just go on the flip side and sell that call. Another really important thing you have to take note of about option trading is how whenever you go farther away from the share price, the premium amount is going to change. So whenever you are above the share price, it is called out of the money. But whenever you are below it, it's called in the money. So the further out of the money you go, whenever you are buying options, so look at this one right here, where you're going to buy a call. And so if you go right above it, so the 562, it costs $4.11. So when you're buying a call, you think it's going to go up. But notice how it gets cheaper when you go up. So why does that happen? All right, so let's take a look on the other side. It gets more and more expensive as you goes down. And that is because it is safer. So when you buy a call, you think it's going to go up. So right now, the stock is at 561, and I think that 562, it's going to go up. However, if we go down to 560, well, the stock is already above 560, so it has a higher chance of staying above. So it's a lot safer, but it's going to cost you a little bit more. And so on the flip side, okay, maybe I don't have $411 to buy this call saying that this stock is going to go up. Okay, well, maybe I think it's still going to go up at least $5. So $5 from there would be up here. So boom, now it's a lot cheaper. It's only $174. So you can kind of change your strike price depending on what you think is going to happen with the stock. If you're not really sure, you're a little hesitant, you want to be safer, and you have more capital to invest, then maybe I go further down here. That way this stock, so let's say if I'll do this one, 555. So now this stock has $6 as $6 before I end up losing a large sum of money. But as you go closer, now the stock only has to drop $1 and I'll be close to my strike price, meaning it's a lot more risky. And the cool thing is, the same thing applies whenever you're buying a put. You think it's going to go down. So it is going to cost more the higher you go up because the share price is already below this strike price. So it's at 561, which is below 566. So there's a higher chance you're going to make money, meaning it's going to cost a little more. But if you don't have that capital, you want to go a little cheaper, a little bit more risky, you can go out of the money. Now it's going to be over here. And yeah, so you get it for a little bit cheaper, a little bit more risky. So risk versus reward, it all depends on what you're comfortable with, what you're okay with spending, and how much you have to spend. And then the same thing applies with selling options. So let's say I want to go down here. I want to sell a put at the 555 mark. So this one, remember, when you sell an option, you have to be able to afford to buy 100 shares at the strike you choose. So that would be $55,000. But this premium is going to be less than this one up here. And the reason for that is because it's a lot more likely to stay above the 555 mark than it is the 561. And then when you go over to sell a call, same thing. We go over to the 566. It's more likely that the share price will stay below this than if we were to go over to the 558. So it's important when you are creating your contract to choose a good expiration date and a good strike price date for you. If you want to be more risky, you can be more risky. If you want to be safer, you can be safer. So here's a quick little recap. When you buy a call, you are bullish. You think it's going to go up. And if the stock price goes up, you are going to earn income. Whenever you buy a put, you are bearish. You think that the market is going to go down. And yeah, if it goes down, you make money. But with a call, if it goes up, you make money. And the expiration dates, when does your contract expire? So you have the rights to 100 shares at whichever strike price you choose. However, it only lasts for the expiration that you choose. Whenever you sell a put option, you are saying for each day that the stock stays above your strike price, you are going to earn part of the premium, which is labeled through the theta decay. Each day you'll get, for this one, it'll be $80. However, the flip side of selling puts, if the share price dips below the strike that you choose, then you will be forced to buy 100 shares at the strike price you chose, regardless of where the share price goes. So the share price could dip a crazy amount, but you're going to be forced to buy it at a higher amount. And whenever you are selling a call, you are saying that the stock is going to stay up below a certain price that you get to choose. And same thing, every day it stays open that it's below, you're going to earn part of this premium. However, if that share price goes above the strike you choose, you'll be forced to sell your shares at a lower price than the current share price for the stock. And then a few key things to remember: with options, you're going to have a lot more leverage. So normally to buy 100 shares of SPY, it would be 561 times 100, which would be roughly $56,000. However, if you just want to have the contract for 100 shares for a day, it's only going to cost you $147. So leverage is your friend whenever you are trading options. And another thing to quickly remember is when you're selling options, time is your friend. So you want to consistently earn part of this premium through the course of your contract's expiration. However, when you're buying options, it's a little bit more risky because time's against you. You only have until your expiration date for your contract to make money. That pretty much sums up everything as far as option trading goes. You're either going to think the market's going up or you think it's going to go down. You can choose when you're going to buy your shares and when you're going to sell them. It's important to utilize all of these options. Don't just stick to buying them, because I personally favor selling options because there's a lot more strategies that you can use. You can combine a few of them, and it really depends on what you're going for. You know, if you want small, consistent growth, or are you looking for those large, high number results, which are a little bit more risky. It all depends on you. But if you have any questions, comments, or concerns, please leave it down below in the comments. Feel free to message me on Instagram, and I'll always respond. If you find that you learned something new, make sure you share it with a friend and give the video a like. With that being said, thank you so much for tuning in, and I'll see you all in the next one.